Good morning, everybody. Monday, August 5th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If there's relevant information during the week, I'll make it on LinkedIn or on Twitter, or X rather. The handles are Herb Morgan and at ETF_strategist, respectively. Presentation is prepared by us. We are a registered investment advisor. It is designed for use by you, whether you are a financial advisor or an individual investor. Regardless, you're expected to make your own decisions. Nothing contained herein should be treated as investment advice, no tax advice, no recommendation for the purchase or sale of any security, and this is strictly for informational purposes only. Its accuracy, adequacy, or completeness cannot be guaranteed. But we had kind of an ugly week. As you can see, stocks sold off on a number of items. We're going to get to the reasons why here shortly. And that has continued over the weekend and into this morning, Monday, which of course, this will be a heavy day for watching of the Slaying Bulls and Bears podcast, I would presume. S&P was down 2% last week. Mid and small cap stocks down much more. International markets down a little bit less, but they're sort of ahead of us, like Asia ahead of us and Europe ahead of us on the calendar. And they had quite a sell-off for what was Sunday night for us here in the U.S. When you have that sell-off in equities, you generally get a flight to quality, so a bid up in bond prices. You can see, look at that, the 20-plus year Treasury index up 6% on the week, driving the yield in the 10-year U.S. Treasury down below 4% when it was just pushing 5% just a couple of months ago. The only thing on the bond side that was down, and it was just barely down, were high yield bonds. High yield bonds often trade in, we call it in sympathy with equities, specifically mid-cap stock equities. It's kind of, we call it mid-cap with a coupon sometimes. But high yield held in there strong, and credit spreads haven't widened out. And if credit spreads haven't widened out and financial conditions haven't deteriorated, it makes you think about whether or not this sell-off is really talking about an impending or current recession, or if there's something more underneath that this sell-off is talking about. We'll get to that in a minute. Let's start with last week's economic data. Plenty of residential real estate data. That's important to all of us, right? FHFA house price index was unchanged. The estimate was for a 0.2% increase. Home prices are up about 5.7% year over year, according to the Federal Housing Finance Agency. S&P Case-Shiller says that housing prices were up 6.8% on a year over year. And for them, the May report showed a gain of 0.34%, just a little bit above the estimate of 0.3. Consumer confidence surprisingly rose a little bit in July, rose just a little bit from 97.8 to 100.3, and that was a little bit above the expectations. So it's nice to get a print above 100. Present situation down a tad. Expectations, though, starting to rise, but still at absolute levels that are kind of low. We got the JOLTS, or job openings report, before we got all the actual jobs reports. The Bureau of Labor Statistics report on job openings for the month of June still shows 8.2 million. There's a lot of talk here. People kind of pick and choose headlines. They make them, titillating to get us interested in reading, and how job openings are plummeting. Well, job openings were 12 million at the beginning of 22, but that was coming out of an economic shutdown related to the pandemic. Job openings really are just back, you can see, back to trend here, and really still above the pre-COVID-19 pandemic level. And so in my view, job openings are still elevated, even though they fell from 8.2 to really 8.2. And we're a little bit above the estimate of 8 million. Weekly claims for unemployment, that's a really good real-time indicator of what's happening in the economy. They rose from 235 to 249. They were above the estimate of 236. And you can see it over here on the right, just kind of rising up off of that 200 level. Anything below 300,000 is a vibrant, healthy economy and a healthy jobs market. The pattern you see here is similar to the pattern we saw last summer. We had some interesting weather-related developments around the country. So while we don't ever like to see the number go higher, there's so much anecdotal data and so much more needs to be heard and seen before we start calling for things like rate cuts because the jobs market and the full employment situation is impacted. We're just not there yet. Sticking on the jobs theme, we got ADP and the Bureau of Labor Statistics jobs reports, both slightly disappointed, but both said the economy added jobs on a net basis in the month of July. ADP says we added 122,000, a little bit below the estimate of 150, and less than the prior month, June, of 155. Okay, we move on to the official government Bureau of Labor Statistics jobs report. They said we added 114. That was well below the 175 estimate. And the prior month, June, was actually revised down from north of 200,000 to 179,000. Suddenly, the participation rate, people willing to work, saying they're in the labor force and looking, is going higher. And that is how you have your unemployment rate go from 4.1 to 4.3. On an absolute basis, more people are employed month over month. Employment grew. But as maybe savings runs out or people are nervous or just for whatever reason, the labor force grew. The participating labor force grew. The other thing to keep in mind, weather could be a factor. 436,000 people were unable to work in July due to bad weather. And the historical average for July, this is all buried in the report, is normally 32,000. Another 1,000 workers usually work, it's a million workers who usually work full time could only work part time due to weather, and that normally is about 194,000. So we are not going to panic over this jobs report, although it got a lot of the blame for the sell-off on Friday. The jobs report came out on Friday, and it took a lot of the blame for the sell-off. And I think it deserves some of the blame because traders trade on headlines, traders trade on reaction. Remember that if you're a long-term investor and you're accumulating assets over the course of your life that are meant to feed you in your retirement, right? Be there for you to decumulate over your life. Who is it that's whipping the market around so much, all the way up and all the way down, big numbers every day? Well, in a broad, diverse market, there are a lot of players, not just good old conservative balanced players like us. There are players that use leverage. There are players that are interested in daily returns, short-term returns, and they can have an outsized effect on security prices. That's okay. That's what gives the market its liquidity. It's what gives the market its depth. Just don't ever let, this is my opinion, don't ever let the daily moves created by those players change your long-term perspective and influence your decision. Don't make it take you from a long-term investor to a short-term investor. And of course, this is evidenced again today on Monday as we move in and we're seeing obviously heightened volatility. That's the word we use, heightened volatility, when the market's going down, and the market's going down today. And that's not a big deal. Buried into that, in addition to the jobs report, is the average hourly earnings. Average hourly earnings rose 0.2% and are up 3.6% on a year-over-year basis. This is on a real basis. We got the final reading. Remember, we got the flash readings the week before on manufacturing from S&P Global and ISM. We got as well final. S&P Global U.S. manufacturing PMI fell into contraction. So remember, manufacturing is about 15% of the U.S. economy. We've had other months below 50. You can see quite a few of them here in the last year, 2 years. And that did not mean we were in a recession then. And it doesn't mean yet we are in a recession here either. The ISM report, of course, has been there for the better part of 2 years. 15% of the U.S. economy has been in contraction, according to this report, with 1 month exception. And it's just the way it is. We move on. Automobile sales, though, were up a little bit. Annualized pace rose to 15.8 from 15.3. You can see that's kind of at the higher end of the last 3 years or so. Interesting because, obviously it's been the higher interest rates, among other things, that are preventing U.S. consumers from buying new automobiles. In terms of earnings season is still going along just fine. We're not seeing outsized numbers of disappointing. We've had 60 out of 376 names that have had disappointing or missed the earnings estimates, where 297 have beaten the earnings estimates. Where's the growth? We're seeing it in healthcare, we're seeing it in utilities, consumer discretionary. If we were in a recession or near a recession, you'd have some just interesting things there. But you can also see there were 10 names that did disappoint. All right, so that's what's going on. What's happening? First, we did have that somewhat disappointing jobs report on Friday. And as you see, if you look through that jobs report, as we just did together, perhaps it's not as bad as the headline showed. What we saw was unemployment went from 4.1% to 4.3%, but the reality is the labor force participation rate expanded. The second thing that happened last week was that the prediction markets began to show a much tighter presidential and therefore congressional race, whereas 2 weeks ago, 3 weeks ago especially, the markets were very clear. There was a clear lead in the polls by former President Trump, who would be seen more as pro-business, pro-growth, more pro capital investment in the economy, less regulatory, and that would be seen as positive for earnings and therefore positive for stocks. Now that Vice President Harris has closed much of that gap, and in some polls even reversed that gap, she has a long history of statements around more regulation, more control, higher corporate tax rates, things that she has favored. What we haven't seen, though, and there's again no reason to panic, we haven't seen, well, what is her new moderated position because she's in an election? What will be the balance of power in Congress if she is elected to the presidency? So I'm not going to say much of this was, like I say, there's part of it's the jobs report. Part of it is the Trump trade reversing, which we know how polls can be. That can change quickly, right? It's a presidential race. We still have 90 days or so. And then I think one of the biggest of all, perhaps the biggest contributor to all this, is that the world has been bracing for an Iranian attack on Israel. On Israel, while it's not a NATO country, is the U.S.'s strongest ally in the Middle East. The U.S. has, regardless of which political party has the White House, will defend Israel. The U.S. is sending additional assets to Israel, to the Gulf region now. As we know, Israel took out two terrorist leaders, one of whom was in Iran at the time, and Iran has stated that they are going to retaliate against Israel. Whether or not they will, whether or not the back channels are working, whether or not the negotiations are working, we don't know. That is uncertainty. Markets don't like uncertainty. I put, of these three items, I put a little bit more weight on this one. In addition to that, markets had been going up for a very long time. Valuations were a little bit above average, not crazy. And we hadn't had an 8 or 10% correction in the stock market for some time. So in a sense, and the calendar, by the way, got to August. What does that mean? Well, August and September are usually the toughest months. Sometimes that moves into October as well. Not a big deal. We are long-term balanced investors. This is part of investing. We are going to have days like this, months like this, weeks like this. The key is that we don't make emotional decisions. We don't react in an emotional way, but we say, let's say stocks go down further. Is it time to rebalance? Sell some of the bonds that have gone up now and buy more stocks that have gone down. The initial fight or flight reaction is what needs to be avoided, in my opinion, to be a successful investor. Avoid the emotional fight or flight reaction. Some things for you to think about. You're going to spend your entire working years trying to accumulate financial assets to prepare for your eventual retirement. Then we spend our retirement assets decumulating those. But we decumulate at a very low pace, right? If we were to decumulate our assets at 0.5% a month, I'm going to just make it simple, call it 6% a year. 6% a year to try to not run out of assets. Most advisors advise to do 4.5, maybe even 5% per year. But this is just illustrative of my point. the total value of your account, which is derived from the stock prices and the bond prices and the index prices and the ETF prices, is really not all that relevant unless you're doing all your buying today or all your selling today. So don't let those prices move you to do something like that. That's silly. It doesn't make sense. Stick to your plan. If you're in the accumulation phase and you've got cash on the sideline, my view is you look at market sell-offs as opportunistic. On the other hand, if you're in the decumulation phase and you see a market decline, that might be an opportunistic chance to rebalance, right? Might maybe rebalance because your bonds are up and your stocks are down. We were a little stretched on valuation, as I mentioned, and I think somewhat due for a correction. And look at that. Just in a matter of days, the NASDAQ's down 12% from its high. The S&P 500 is down 8% from its high, and small cap stocks are down 9% just since Thursday. So are you down 12? Are you down 7.9? Are you down 9.2? Well, only if you bought on that one day, the one day of that all-time high. And I submit to you that you probably didn't. And that only if that was your only investment. It wasn't, right? I'm 58 years old. I've been investing in stocks and bonds and alternatives for 35 years. And so I've been accumulating my 401k contributions, all of those things that you do to accumulate. Those are the days that matter. And there are many of them. So being down 12% in the NASDAQ from an all-time high and then going on to worry about it or fret about it, when you really frame it properly, is silly. The other thing that's contributing is the Nikkei. Of course, Japan raised interest rates. Their central bank Bank of Japan raised interest rates. Japan has been a troubled economy for the better part of 3 decades now. And in less than a month, the Nikkei 225 index is down 25.5%. But it is weeks like this and days like this. When the market's going straight up, the number one call I get is, why am I in a balanced portfolio? Why wouldn't I be all in for the equity market? And we explain, because this happens. Now it's happening. And balanced portfolios, that's what you have. Your bonds are going up in value. Your liquid alternative investments performing fine, up in value. The one that we use is doing fine. But this particular week and this particular day, the stocks are down. That's okay. That's normal. Okay, moving on. Economic data this week. Services PMI from S&P Global and ISM. They're both out this morning. They're both fine. They're both above 50. So 85% of the U.S. economy expanding. You saw the jobs openings, the weekly claims. None of those are reasons for panic. I heard stuff over the weekend. The Fed will have an emergency meeting and cut rates. That's just silly. The Fed doesn't do that unless there's a real reason to do it. Trade deficit tomorrow, consumer credit on Wednesday, weekly claims for unemployment on Thursday, and nothing really scheduled on Friday. I'm going on vacation tomorrow. I'll be gone for a couple of weeks, so we will not have this podcast next Monday, July 12th, and probably not on the 19th. I'm going to get back late on the 19th. So, of course, if something major happens, I'll be in contact, obviously, with my team here, and we'll get word out to you if there's a particular reason to. Thanks for tuning in, everybody. We'll be back to you in just a couple of weeks.